in today's video, we're going to be talking about the 30-year mortgage versus the 15-year mortgage. And there's many people out there that say 15-year mortgage, you get to save money on interest because in some cases your interest rate is cheaper and you get to pay off your mortgage faster and all these things. And they almost make it sound like the 15-year mortgage, Todd, is the greatest tool and you're a total genius if all you do is a 15 versus 30. There's big time names out there that will literally say like that's what you should do, and we're just going to run the math and talk through 15 versus 30. And we're not mortgage lenders. We don't necessarily have a horse in the race here, but I think by the end of this video you'll have a better mindset, operating system framework on how to make that decision.
Yeah, so thanks for having me. This is an interesting topic because it's so misunderstood. There's so much information out there that's not true around it, and we're going to look at the pure math first, and then there's also some pieces here that have to do with discipline, and that's kind of outside of that. And if we don't have discipline, then the pure math really doesn't make it doesn't make the difference. And so, but we're going to look at it from the standpoint that we're very disciplined, we understand the cash flows, and we keep the cash flows the same, and we're going to go through it in that light and just look at where some of the misinformation comes from and whether or not it's true.
Love it.
All right. So let's just start here, and let's say that we had, we're going to put an illustration period of 30 years or 360 months. We're going to go all the way out there with the full mortgage just to look at our illustration period all the way out. And this is one of the areas, before we dig in completely, that's often a place of misinformation. And what happens is the illustration period or the time frame we're looking at as a whole changes whether we have a 15-year mortgage or a 30-year mortgage, and it shouldn't, right? We have to have the same time frame for the analysis. So if we choose to look at a 30-year mortgage over a 30-year period, then we have to look at a 15-year mortgage over a 30-year period as well. We can't change that illustration period and have a valid comparison.
Yeah.
And so we're going to pick the longest time frame. It just makes it easier, and we're going to go the whole 360 months. And then let's say that we had a $500,000 house that has a $400,000 mortgage, right? Because we're borrowing 80% of the value. So let's put a $400,000 mortgage. Let's put a 6% loan rate.
And just for the people watching, there are houses out there for $500,000. I know you might be watching this in California or New York. I'm in Nashville, Tennessee, and you can't buy a ton for $500, but it's possible. So just throwing that out there.
And it's just zeros, right? We could always multiply
That's
it up if we needed to or whatever else. So, all right. And then remaining monthly payments on this one, let's put 360 months. And what we see here is a payment of $2,388. Sorry, $2,398 across this time frame each month. And then we actually have an amortization schedule that shows that balance slowly declining in the early years and then finally picking up speed at the end, right? And that's one of the areas where a lot of times people will say, well, a mortgage is constructed in such a way that you pay interest first and nothing goes to the principal. But that's not really what happens. Even though that's some of the verbiage around it, what happens is we just have more money borrowed. Therefore, there's a higher interest amount in relationship to the payment in the beginning than there is at the end. It's just a function of how big that mortgage is and how much interest is being driven, right?
Right.
And so a lot of times, because of the amount of interest that gets paid, that's what causes people to get concerned. It allows them to really make the wrong decisions. We always make the wrong decisions when we're afraid of something. People get afraid of the amount of interest that's going to get paid. And if we look at this, if we just turn on that cost summary at the top, then what we're going to see is, that we're going to pay $863,000 total. That's the cumulative payments across this time frame, right? Well, we only borrowed $400,000, so that means we're going to pay $463,000 in interest, and that's what scares people. It's like, wow, I'm going to pay more in interest than what my house cost, right?
That's right.
That's more than double the cost of my house, and so it drives behavior that's really not in alignment with financial math. And what I mean by that is, I've seen people that are so driven by trying to tackle that interest because it's this large amount that they'll literally have maybe 18% credit card debt
Yeah.
that they're paying minimums on while they're trying to funnel more money here, even though this is only 6% debt. And it's backwards because we get confused by that volume of interest versus the rate that we're paying on that interest or the real cost of it.
Yeah, I've seen lots of videos and advice on people that say we should pay multiple, like bi-weekly kind of deal. And I know we're gonna have a part 2 to this, so we won't have to. I don't want you to get into it now. But if you're watching, please subscribe and follow, because we are going to have another one where we address that. But the same philosophy is the same across the board when we talk about 15 versus, having a 30-year mortgage and paying, twice a month. Everyone's looking at that $463,000 of interest and saying, what if that could be cut in half? And that becomes like the thing that we rally behind, but we forget to factor in opportunity cost, or what you could do if you choose a different scenario.
Yep, that's exactly right. And so people are driven to, and that's why, as you mentioned earlier, that 15-year mortgage, right? That's a place where we can supposedly save a bunch of interest. And so let's look at that on loan 2 here for just a minute. So if we go over to loan 2 and we put in the same mortgage amount, the $400,000, same interest rate, and yes, I know that there's some differences. Typically, the 15-year mortgage is going to be a quarter of a point less than the 30-year mortgage, but we're going to keep it all the same just for this analysis. We can adjust it at the end.
Cool.
But let's keep it this way for now. I just think it'll make it a little clearer. Put 180 months for the time frame. And now what we see is that dropped our cumulative payments to $607,000, which means we only paid $207,000 in interest here. And so that's less than half of what we're going to pay on the 30-year mortgage. And so this really drives a lot of behavior, seeing, what people think is actually savings.
Yeah, and if we pull up the payment, what's the payment on the 30-year?
Yeah, let's just look at both of them.
This is what people will say. It's like you have a payment of let's say 2,400 versus 3,000, round up 400, and so you look at that from a standpoint. You're like, okay, it's about $1,000 difference, but now you pay half the interest. So you can see
Right.
where it's like, that's really attractive. Like, I'll get behind that. Like, that's amazing.
Yeah. And there's so much talk around that because all anybody does is think about that interest, that big thing out there that's really haunting them at night, right? And what they're paying. So people are easy prey to some of that talk. And so we really need to dig in and look at the numbers for a minute. But let's just say for a second that were true. That the fact that we paid more interest means we have more cost. The fact that the 15-year mortgage is less interest, therefore our house costs less. What would be the cheapest? And cash really is the answer there, right? If we could pay cash, we'd pay no interest. So that would be the cheapest way to do it. But what we have to start thinking about is, okay, how are we going to pay cash? We would literally have to liquidate $400,000 out of our savings in order to do that. But if we do that, are we not giving up what that $400,000 was going to grow to? And so let's just look at that for just a minute. And if we grab a calculator, a future value calculator, and look at what $400,000 would have grown to had we not pulled it out to pay off the house and take advantage of paying zero in interest on our house. We put $400,000 in there, a monthly and end of period, at that 6% rate for 360 months, just sitting there, that would actually grow to $2.4 million. Here, once we see what happens, that $400,000 would have grown, assuming it earned 6% all the way out, to $2.4 million. So that decision to get rid of what we were afraid of, $463,000 in interest costs, actually took $2.4 million away from us over that time frame, right? And so that's the part that's left out. It's like, most people would say, man, that'd be the best if I could just pay it off. But we have to remember what we're giving up. I have a friend that talks about interest this way. You either pay up interest, like to a lender, or you pass up interest. And it's the same thing net at the end of the day, right? At the 30-year mark, it doesn't make any difference. Here, we're giving up basically $2 million in interest
Yep.
earnings over that time frame, right?
Yep.
If we made this decision.
For the listener or the person watching this on YouTube, would that $2 million represent the opportunity cost factor that we need to start factoring into the 15 versus the 30-year mortgage?
Yeah. And so think about this, though. If I did this, if I made this decision to pull $400,000 out, give up that future value of $2.4 million, pay off my house, I would free up that payment, wouldn't I? And then I could put that into a savings vehicle. So
Sure.
That might be an option. And so if we grab another future value calculator here real quick, then what we see here is if we change it to monthly and end, and we copy that payment, make sure these are on top, we paid off the house, so now we freed up the $23.98 that's going to the mortgage company. We can stick it in that same account, and look at that. That number is exactly the same as the cash. So either of those two decisions, at the 30-year mark, I end up in the same place. I end up with my house paid off and either the $2.4 million on the left or the $2.4 million on the right, depending on whether I paid cash or continued to funnel that payment in there and left my cash alone. So either of those decisions is the same. And most people, it's like, wait a second, how could that be? In one, we paid no interest on our mortgage. In the other one, we paid $463,000 in mortgage, but yet the cost, two of them, once we add the element of time, is exactly the same in either of those two decisions. And this is going to be a hard thing for a lot of people to get their head around. It really is.
Yeah, no, I appreciate you breaking this down. And again, there's a lot of half truths out there. This is what I ended up getting caught into in my book, The And Asset. Is it's one of those things where it's like, yeah, you can look at math and you can have a half truth, but you have to factor in opportunity cost, which essentially means whether you pay cash or that you do a 30-year mortgage at the 6% interest rate being the same over 30 years, if you're assuming that the person that pays cash is going to take their mortgage payment, put it into an account, earn 6%, never less, never more, it's identical. And obviously, like math, that's important to know the math, but then it's also important to take that fact and then ask the question, knowing where math stands, what gives me more control, what's more likely to happen. There's other factors that we can talk about, but I appreciate you breaking this down. And I feel like there's a lot of miscommunication when it comes to this.
Yep. Yeah, and like I said, we'll talk about just the math right now, but when we get back to the end of it, we'll bring in the discipline and some other pieces that are around it. But yeah, so here, these two are the same. Well, what about the 180-month mortgage? And I know that's a question out there because a lot of people are saying, well, yeah, but we're only paying that for 180 months, so it's got to be less. And we saw it had less interest. But we also saw cash had zero interest, right? And it still costs us the same. But let's go through the exercise with the 180-month mortgage just so everybody understands how that works as well. So let's grab another future value calculator, end and monthly. And on this one, we're going to have that larger payment. Rather than just $23.98.20 per month, we're actually going to be putting in a little over $3,300 a month in order to get it paid off in that 180-month time frame. That's what cut our interest way back, right? Because we were accelerating that payoff. And at the end of 180 months, what we see is, well, we've only got $981,000 of cost here. But right there in that analysis, we're not showing the whole truth. We're using two different illustration periods. And that's what we started with at the beginning, is talking about how in order to have a valid comparison, our time frame we're looking at has to be the same. So even though the house is paid off at the end of 180 months, we need to continue that out for the next 180 months without a payment and see what that looks like. So we're going to take this $981,000 of money at the end of 180 months and then do that from month 181 out to month 360 so that we have the full time frame. And we see it's the same $2.4 million. And this is really tough. And it doesn't matter. As long as the interest rates are the same, It doesn't matter how long the mortgage is. The cost is going to be exactly the same across the board. And the fact that we paid wildly different amounts of interest is really irrelevant, right? It doesn't have anything to do with it. 0% interest, or sorry, zero cumulative interest, $463,000 cumulative interest, $200,000 cumulative interest. It's all over the board, and yet the cost is exactly the same if the interest rates are the same, right?
I really appreciate you breaking this down. And I think we could stop here if we wanted and just say, like, drop the microphone. But I think if we take it a step further, knowing this and start talking about like what you should be thinking when you start making a decision, because at the end of the day, what someone could conclude from this is whether you pay cash, whether you do a 30-year mortgage, or whether you do a 15-year mortgage, it's all the same. And number one, someone playing devil's advocate could say, well, 15-year mortgage, the rate is lower.
Yep.
And if you just use that logic, you could talk yourself into doing a 15-year mortgage. But then some other people could say, well, let's factor in risk. Let's factor in the unknowns. Let's factor in, a lot of different areas of like, would you rather have a paid off house and no money, or potentially cash in a side account with the ability to choose more options? And so let's flesh that out more from a standpoint of like how you, being the numbers guy, think about 30-year, 15, or paying cash for a home.
Yeah. So all of those things are in the equation. And when it comes to risk, that is one of the driving forces for people wanting to accelerate that payoff. A lot of times it's like, I'm afraid I'm going to lose my job for a period of time. I'm afraid I might get a disability for a period of time, and I don't want to lose my house. And their decision, their fear causes them to make a decision of accelerating that payment to the bank, which is exactly what the bank wants, right?
Yep.
They would love for you to have more equity, because that puts the bank in a less risky situation. In other words, if you have problems making the payments and you've got a bunch of equity there, they could sell that house at auction and cover what's remaining on the note, right? And so they're going to encourage us to go that direction. But think about it from our standpoint as the consumer. The more money we put into the house, and yes, our equity goes up, but we have to get permission to get it. And the only way we can get it is if we can show we can pay it back, right? And it's up to the bank to decide. So if we have one of those issues of losing a job or having a temporary disability, the bank's not going to let us tap into that equity. But if we had this money outside, so in other words, if we took that longer mortgage and funneled the difference in the payments into a side account, when one of those emergencies came up, we'd have a source of funds to be able to make that payment and maybe keep the house. Also, the bank's probably going to be more likely to negotiate with us if they're upside down on that mortgage, right? They don't want that real estate on the books. And so it really puts us in the driver's seat. But it comes down to discipline, and that's a big piece. If we're not disciplined enough to put that difference in there and we're just blowing it, then we're really not going to be any better off in the long run. And we're not going to have that safety net. And we're going to say, wow, I wish I'd paid this off in 180 months. I'd be done with this thing by now. Take some discipline. If we're willing to pay $3,300 on the 180-month mortgage, we should be willing to pay $3,300 in a different strategy that we could accomplish the same method. A good friend in our business, Michael Isom, he says, there's a difference between objective and method, and sometimes those get confused. So if your objective is to pay the house off in 15 years, that's fine. But maybe the method you're using of accelerating the payment isn't the best way to get there, right? Maybe using a different method to get to the same objective with some certainty around it, because we're in a position of cash in an emergency.
Let me say back to you what I'm hearing, and you let me know if I'm on the same page. So in a 15-year mortgage, a lot of times they will even give you a lower interest rate. And it's not because the bank is wanting to pat you on the back saying, hey, great job, you're being a responsible human. Their banks are in the process of making money. And if you think about it, like a loan is an asset to the bank, and they're taking risk. And if you're paying them back more money and paying off that loan faster from a risk position, they have more equity in the home, which puts them in more control, which means that they're just as profitable charging you less of an interest rate, hence why they're incentivizing you to literally take that deal. Why? Because if an unknown thing happens in the future, they're in the driver's seat. And if you're on the consumer side, you're paying off your home, you're paying off your home, you're paying off your home. Best case scenario, we look at the math here, you pay off your home in 15 years, and then you're able to invest all the money that you were paying, and maybe at the end of 30 years, it's the same scenario. But if something happens, get a disability, lose a job, there's a lot of unknowns. Maybe you want to change your jobs or maybe take extra risk. You have your money in your home, and someone once told me that banks love to lend money to people that don't need it, hate to lend money to people that need it. And so if something does happen to you, there's either you need to sell the home. Well, right, like this is a perfect example. With high interest rates, it might be hard to sell homes, so you might end up losing money trying to sell a home. Or you go back to a bank and say, hey, can I refinance? Well, if you're disabled, if you don't have a job, if you got let go, like the banks aren't going to necessarily give you favorable terms and even say yes. And so what I would even say, and maybe this is me pushing my agenda in the video, but it's like some people get into 15-year mortgages because they like the safety of having a paid off home. But it's one of the most, like, I would sleep less well at night on that route, knowing that if like in the next 15 years, I have a lot less options than a 30-year. Based on what I just shared with you. I'm not even looking at the math of like over 30 years, it almost equaling the same. Or the 15-year mortgage, if we just use the same 6% opportunity cost, would actually be farther ahead if we use less interest, but factor in a 6% rate of return. Like in a bubble over 30 years, you'd be ahead in the quote unquote 15-year mortgage, but like the amount of risk and uncertainty that you'd be taking on wouldn't be ideal. On the flip side, if you have no discipline, then it's one of those things where discipline does matter, and that's, if you're not willing to save the difference, then the whole thing goes out the window.
Yep, exactly. And so there's a difference between the math and the real world, right? If in your real world you don't have the discipline, then maybe taking that shorter mortgage is a better option, but it really does expose you to more risk instead of what most people think. And it's just the opposite, right? Most people think they're reducing risk. But the closer you get to having it 100% paid off without having it 100% paid off, the more risk you have, the more equity is on the line that you could just lose very quickly if something changed dramatically in your life, right?
Yeah, and just to prove that, because I don't think we did that with the 30-year mortgage, what you would do is you would look at the difference between the 15-year mortgage and the 30-year. You would subtract that, and then you would assume that you're earning 6% over 360 months, and you would get 2.4 million, the same exact number. Even though we didn't do that on the calculator, that's the assumption.
Well, not the 2.4 million. So let's talk about what you're saying right there. So here's what a lot of people will think, and we hear this from mortgage brokers sometimes. It's like, not only do you pay less interest on the shorter mortgage, but in 15 years that house is going to be paid off, and now you can start saving that $3,300 a month. Yep. Right? Makes sense? And so if we look at this future value calculator on the lower left, where we have 3,300 for 180 months, and it grows to 981,000. So think about this. If we had paid that and had the house paid off, and now from month 181 out to month 360, we could save that $3,300, we would end up with that $981,000 at the end of that time frame, right?
That's right.
But we've got two totally different amounts of cash flow now that we're talking about. We're talking about spending $3,375.43 a month for 360 months. And a lot of people will say, wait, no, we're only doing it for 180. No, you're doing it for 360. The first 180 months went to the mortgage.
That's right.
And then the next 180 months went to the savings. And so we can't compare $3,375 a month over 360 months to $2,398 unless we take the difference in that from day one. Right. And start saving it right off the bat. So let's do that and see what we end up with. So if we get another future value calculator and are intent on saving that difference between those two payments all the way out. So if you right click on the monthly payment, copy the difference with all the decimal places just so we can see. And at 6%, so there's a $977.23 difference between those two payments. At 6% for 360 months, we end up with the same $981,637. There's no difference if the interest rates are the same. So the time frame doesn't matter if we understand that, paying interest is the opposite of getting interest, or getting interest is the opposite of paying interest. I mean, they're still the same thing in the big picture. In other words, let's say I had a 6% debt and I pay more towards that. It's the same as earning 6%, right? Even though we have a hard time seeing that.
I would encourage the viewer to rewatch this video if you're at all like confused, because this is like therapy. I can tell that this is like you build calculators for your therapy sessions, Todd, because this is like very, very beautiful. This all makes sense, and it's really helped me when I understand some of this, because I don't just watch a TikTok video and like, oh, there's this magic loophole. It's like, no, like if you understand this basic math, you have a lot more common sense and a higher investor IQ because you're understanding both sides. And so, question for you is, if someone says, well, I can get a cheaper rate on a 15-year mortgage, I gave you my 2 cents, like the philosophy, how would you answer that if someone said, well, I could do a 15-year mortgage, but it would be a 0.25%
575,
cheaper.
Right.
Yeah.
Yep, perfect. That's where we need to go. I just want to initially get everybody to understand how, from a gross cost standpoint, they all cost the same if the interest rates are the same. And now we'll mix that up a little bit and go to more reality. So let's go back to our calculator. So we need to minimize all those. Okay, so here let's look at our if we look at our cost summary, as we can see here, $863,000 on the left, 607 on the right. Again, that's just cumulative right now. So we need to add our 6% savings rate to this so that it'll show up, and now we'll see the 2 million, 2.4 million that we saw earlier with our future value calculator. So they're exactly the same here. But as you pointed out, that 15-year mortgage is probably going to have a 1/4 point less in interest rate. Why? That's a carrot. You mentioned it earlier that the bank throws out there because they want us to do that faster mortgage, right? They don't want those dollars getting diluted by inflation and other things. They want them back as quick as possible so that they can turn them back out in another loan. But if we reduce that to 5.75, what we see is that is a little bit cheaper. It's about $39,000, about $40,000 cheaper over that whole time frame. But there's another piece that's getting left out of the equation in what we have right here. And that other piece is the deduction that we get, at least in the US, on making this decision. Now, I would still do this if this was all that was available. Just to me, that's pretty inexpensive insurance to make sure I have money aside to pay. And who knows, I might have a great opportunity that comes along that's way better than 6%, right?
I was just about to say that. It's like we're just looking at what's a fact from a standpoint of loan rate, but we're assuming a 6%. And if you're entrepreneurial at all, what are the opportunity of over the next 30 years you might be able to make a move or a decision that results in more than 6%? And in one scenario, you have a lot more gunpowder to take advantage of that versus the other. So but let's continue. Like, I'm glad you pointed that out, but let's assume that's not the case. But if you're an entrepreneur, hopefully you get that logic that both Todd and I just mentioned.
So let's do this. Let's put a 24% tax bracket on both of them. And what we see is on that longer mortgage that's supposed to have all the cost, it actually has a higher tax deduction. Because we pay more interest, we actually get more tax deduction. And in the end, even though we're paying a 1/4 point less on the 180-month mortgage, it actually costs us $130,000 more because of less deduction. Now, wait a second. Why do we get less deduction on the shorter mortgage? And the reason is because it's happened in that shorter time frame, we're eating up the interest, and therefore we're eating up the tax deduction. And so from a gross standpoint, if they cost the same and we get more of a tax deduction on the longer one, the net cost at the end of the day is actually less on the one that's supposed to be the most expensive. And think about this. What's the cost of the cash decision? It's the full $2.4 million. Because we get no deduction on that one.
That's right. It's good.
It's actually completely backwards. What's that?
I'm just agreeing with you. I really appreciate you laying this out. Is there anything else you want to say? Because I have another question for you.
No.
Let's say the opportunity cost of what you could earn is 8% every year. Let's just say that. Does the math still, is it one decision's not necessarily better than the other? Or how would that affect scenario A, 30-year mortgage, versus scenario B, if assuming you could earn 8%, but the loan rate was 6% across the board?
Great question. Actually, the higher is going to favor the longer mortgage time frame. So let's put 8 in both of those. And think about it like this. This is kind of what's going on while those numbers are being put in. We're literally investing 6% to get 8%. Now, when that flips the other way, that could be a different picture. If we can't earn that higher amount, it could be a problem. So here, if we could earn 8 on both of these, wow. Now then the one on the left-hand side is almost $500,000 cheaper. That longer mortgage, almost $500,000 cheaper than the 30-year mortgage because of that higher rate of return as our opportunity on the other side for that difference in payments. Yeah, the one on the left, the 360-month mortgage, is actually less expensive than the one on the right, the 180-month mortgage, by almost $500,000 when we increase that interest rate just by a couple of points up to 8%. And so one of the things that we talked about earlier, the idea behind method and objective, let's say we really wanted it paid off in 15 years, right? Well, if we scroll down to the 15-year mark, what we see is that we're going to owe, so the end of the 180th month or the beginning of the 181st month, there's $284,000 worth of, or $285,000 almost, that we owe at that point in time, right? Now we see from our tax deduction, we'd have about $150,000, but what about the difference in that payment, right? And so if we go back to our future value calculator and think about if we have that discipline to save that differential, and if we could do that, do you want to do that at your 8% number or the 6?
Yeah, do that at the 8% number, please.
Okay, if we did that at the 8 and just go out 180 months,
boom,
there's $338,000. There's more than enough in that to pay it off, not even counting the difference in the advantage of the tax deduction, right? So just purely in those dollars, we could then at that point in time say, you know what? Yep. Does it make sense for me to clear the mortgage completely? Because then I own it, right? Then I don't have to answer to the bank. And so I can see some, where some people would feel empowered by that, being in that position. And they might say, yeah, you know what? I just want it paid off. Okay, we got it paid off in the 15 years. Or we might get out there and say, $338,000, I could start a business that would pay me and make my mortgage payment. Maybe I just want to keep doing that, right? But it puts us in a position of options versus locking us in to really the bank's plan.
That's right. And I appreciate you breaking this down, because you would even say that if you want to pay it off in 15 years, you don't have to necessarily lock yourself into a 15-year mortgage. Even at the lower interest rate, you have more options, and who knows most people don't know what they're going to do next week, let alone 5 years from now, and let alone 15 years from now. For me, I would love more options. We don't know what the next 15 years are going to look like. Which position puts you in more flexibility? Which position gives you options? And there's a value for options. Now, in this case, there's actually more money. But even if the interest rate was, let's say, 4%, the 15-year mortgage, correct me if I'm wrong, Todd, would win mathematically if the opportunity cost was 4%. And again, that's assuming over the next 30 years, you only make 4%. But I would even choose in that scenario that with optionality, with potential upside, even though it's not factored in, because of just my desire for control.
Yep. I I agree with you 100%. And I mean, we could look at that, put 4% on this, and we're going to see that we're not going to have quite enough to pay it off. Probably the combination of that and the tax deduction we would. But there's 240, and what do we owe?
Yeah, 280. Is it 284?
Yeah, I mean we're close right there, and the difference, we've got an extra 60,000 in tax deductions, and if we applied those in the process, we'd still have enough to pay it off.
Yeah.
Right.
Yeah. So
Which is
go on.
Oh, I was just say it's just pretty phenomenal how far off base
Yep.
we've been told that this is, right?
Yep. No, I agree. And I think the one thing that we need to factor in is discipline. And if people are listening to, let's say, Dave Ramsey with a coach, specialist, advisor, person that's holding their hand, the discipline to stay consistent and save the difference, invest the difference, you can see where most people, just the data, like most people aren't doing that. So you can see where if you just force people into a 15-year, or even if you say you need cash before buying something, it does two things. I'm giving the benefit of the doubt. It allows people to not overconsume. So if you pay cash for a home, instead of buying a $900,000 home, you might buy a $300,000 home. That's not apples to apples, but you could make the argument that you shouldn't, a piece of debt enabled you to buy a house that you shouldn't afford. And then the second thing is, if you're not disciplined, it just automatically makes you play a smaller game, which in that case gets you out of trouble because it's limiting your consumption. So I am like, there's math, and then there's the people that watch this are always thinking opportunity costs, what they can do. But if you look at the real world and human behavior, I do understand, and I'm very empathetic why, there's people out there that challenge people to pay off as fast as possible because they're not saving or investing the difference, they're spending the difference. And as a result, they're hosed from the get-go.
Right. And that same idea is true for, savings vehicles. You think about qualified plan vehicles, the 401k. Some people will literally say, I put it in there because I know I can't touch it because I don't have discipline.
Yep.
Okay, well, in that case, that's probably a good thing for you. But man, having access to those funds in the right way with the right discipline, you could make them way bigger potentially than what you can, accumulate inside of that confined space, right? Yep. Where it's locked down, and maybe end up with something by having it in there that you would have otherwise blown. So I don't know. It comes down to people.
Yeah, and I literally interviewed Ted Benna, who founded the 401k, and I asked him what he liked most about the 401k, and he literally said it restricts people from accessing their money. I was like, well, yes, it does.
Well, the pros are, first of all, help convert spenders into savers.
Yep.
By making that the first priority. And many employees, including me, would have never accumulated what they did without, that being possible.
And that's hilarious how some of my friends say that that's the worst thing and why they don't like it. And there's others that say it's the best thing because it eliminates people from making worse decisions by taking out that money and spend. And I think the point that we're trying to make is, in this video, we're not telling you what you should or should not do, but I really hope that you watch this video, send this to your friends, maybe send this to the person you're working with, because if you can understand what Todd and I are talking about, it's empowering. It's empowering as you make decisions. And we're going to do part 2 here in a second. You're going to see a lot of TikTok videos and people saying, like, there's an amazing secret. Don't do the 15-year mortgage. Don't do the 30-year mortgage. Pick a mortgage and pay twice a month. And voila, like, that's some magical thing, because now you're not just saving on interest, but you're reducing principal, which saves on interest. And there's like this magical equation. And newsflash, math is math, and we're gonna talk about that in a second. But I think that this is empowering to know. And the last thing that I want to say is, if you want to learn more about this from how does this make sense, Kim, your wife, Todd, wrote an amazing book called Busting the Interest Rate Lies, where she breaks down all of this and more, and in a way, it could be a lot easier for people to follow. And so if this is something that is like you want to learn more, please check out the Amazon link down below. And again, we're just hoping to continue to elevate the financial IQ. Is there anything else that you want to say, Todd, as we wrap this up?
No, I think, you know, the mortgage is probably one of the most emotional decisions that people make, and it's really hard to separate yourself from that. But you really do, to make a good decision, you need to separate from that. And the decision might be, you know what, I see the math, and I don't trust myself, so I want to accelerate the mortgage. That could be an option, but do it from a standpoint of education, where you're making good decisions and you know why you're making those decisions, versus some of the rhetoric that's out there in the marketplace that's not true, right?
I love it. All right, subscribe for more videos.